Many people dream of achieving financial freedom, yet only a small fraction ever truly attain it. Despite widespread access to information and resources, most individuals find themselves caught in a seductive trap that keeps them from reaching their goals. This trap often involves instant gratification, emotional spending, and the allure of quick fixes. Beginners, in particular, are vulnerable to common pitfalls such as underestimating the importance of discipline and consistency. They may know what steps to take, but struggle to follow through when faced with daily temptations and setbacks. Understanding these obstacles is the first step toward breaking free and moving closer to lasting financial independence. Warren Buffett often points out that while many people possess the knowledge required for investing, only a small percentage, about 2%, actually achieve lasting success. He attributes this gap not to intelligence, but to behavior. Buffett emphasizes that emotional discipline, patience, and the ability to stick to sound principles are far more important than simply knowing financial formulas. Central to his philosophy is the concept of the circle of competence, which encourages investors to focus only on areas they truly understand. By staying within this circle and making consistent, rational decisions, investors can avoid costly mistakes. It is this disciplined approach, rather than chasing trends or acting on impulse, that sets successful investors apart from the rest. Rose Blumkin's remarkable journey began with humble origins and a relentless work ethic. Through unwavering discipline, she built her business from the ground up, always putting the needs of her customers first. Rather than seeking shortcuts or relying on flashes of genius, Rose focused on consistent reinvestment and steady improvement. Her story demonstrates that enduring success is rooted in universal principles: hard work, integrity, and a long-term perspective. These values not only fueled her rise to a billion-dollar enterprise, but also serve as timeless lessons for anyone pursuing success in business or investing. Rose's legacy reminds us that sustainable achievement is built on a foundation of patience and dedication. Throughout history, influential figures such as Henry Ford and Warren Buffett have shown that setbacks can be powerful teachers. Their journeys highlight the importance of resilience and the willingness to honestly evaluate one's decisions. To apply these lessons, start by documenting your experiences, both successes and failures, in a personal manual. Regularly review this record to identify patterns and areas for improvement. Set clear, achievable goals, and adjust your strategies based on what you learn. By embracing mistakes as opportunities for growth and maintaining steady progress, you can build a strong foundation for long-term financial success. Legendary investors such as Warren Buffett have built enduring success by faithfully adhering to fundamental investment principles over decades. Rather than chasing trends or reacting to market noise, they focus on disciplined reinvestment and the steady accumulation of value. This approach is rooted in what Buffett calls compounded integrity, where consistent, principled decisions build trust and long-term results. By ignoring distractions and maintaining a clear strategy, these investors avoid costly mistakes and capitalize on opportunities others might overlook. Their unwavering commitment to simplicity and patience sets them apart, proving that sustainable wealth is often the product of persistent, thoughtful action. In essence, their legacy demonstrates that mastery lies not in complexity, but in the relentless application of sound basics. Warren Buffett's investment philosophy centers on viewing investing as a long-term partnership with trustworthy companies, rather than engaging in short-term speculation. He believes that success comes from selecting businesses with stable earnings, strong management, and clear competitive advantages. These three key criteria help identify predictable assets that are likely to perform well over time. Importantly, Buffett's approach is not reserved for experts or insiders. It's accessible to ordinary investors who focus on understanding the fundamentals of a company. By prioritizing reliability and long-term growth, anyone can apply these principles to build a resilient investment portfolio. Building lasting wealth requires a thoughtful approach that balances risk and opportunity. Diversification is key, as spreading investments across different asset classes can help reduce exposure to market volatility. Maintaining liquidity is equally important. ensuring you have funds readily available to seize new opportunities as they arise. To guard against inflation, consider allocating a portion of your portfolio to assets such as gold or Bitcoin, which can act as hedges when traditional currencies lose value. Beyond financial investments, investing in your own education is a critical strategy that is often overlooked. Expanding your knowledge and skills not only enhances your earning potential, but also empowers you to make informed decisions in an ever-changing financial landscape. Developing emotional stability and consistency is essential for long-term investing success. One effective approach is to create a personal decision manual, outlining your investment principles and strategies to guide you during uncertain times. Keeping an investment journal allows you to track your decisions, reflect on outcomes, and learn from past experiences. Committing to fixed monthly investments helps remove the temptation to time the market, while automatic dividend reinvestment ensures your returns compound over time. Regular portfolio reviews keep your investments aligned with your goals and risk tolerance. By following these practices, you can avoid common pitfalls and lay the groundwork for a resilient financial future. Legendary investors such as Warren Buffett have built their success not through complex strategies, but by consistently applying fundamental principles over time. Their unwavering commitment to these basics creates a powerful effect known as compounded integrity. This concept highlights how disciplined behavior, repeated day after day, leads to exponential growth, not only in financial wealth, but also in personal confidence and reputation. By making thoughtful decisions and sticking to their values, these investors demonstrate that small positive actions can accumulate into remarkable achievements. Their journeys show that patience, discipline, and integrity are essential ingredients for long-term success. Warren Buffett's investment philosophy centers on viewing each investment as a long-term partnership with a company. He seeks out businesses that consistently deliver value over time, rather than chasing quick gains. Buffett emphasizes three key criteria when selecting assets: predictability of earnings, strong and transparent governance, and effective reinvestment strategies. By focusing on companies with reliable profits, he minimizes uncertainty and maximizes the potential for steady growth. Good governance ensures that management acts in the best interests of shareholders, while smart reinvestment strategies help the business compound its value. This disciplined approach has been a cornerstone of Buffett's enduring success in the world of investing. Building a resilient portfolio involves several practical strategies. Diversification is key, as spreading investments across different asset classes can help reduce risk and smooth out returns. Holding cash reserves provides flexibility, allowing investors to seize new opportunities when markets fluctuate. Allocating assets to protect against inflation, such as investing in real estate or commodities, can help preserve purchasing power over time. Beyond financial assets, investing in personal education is a vital yet often overlooked component. Expanding your knowledge and skills not only enhances decision-making, but also increases adaptability in an ever-changing financial landscape. By combining these approaches, individuals can strengthen their portfolios and better navigate economic uncertainties. Adopting a behavioral framework for investment decisions can significantly improve outcomes. By creating a personal decision manual, investors establish clear guidelines that help navigate complex choices. Asking key questions before investing encourages thoughtful analysis and reduces impulsive actions. Consistency in following these principles fosters emotional stability, making it easier to avoid common mistakes driven by fear or greed. Tools such as an investment journal provide a record of decisions and reflections, offering valuable insights over time. This disciplined approach not only minimizes errors, but also lays the foundation for building lasting wealth.